Hello class, and welcome to yet another installment of Accounting to 11 YouTube videos. Now we're really getting to the fun stuff, This is where we're grinding it out. When you're going through these problems, I recommend it's time to roll up our sleeves and get down to business, accounting style. So what we're going to go through today is E11A-2, and I think if we're able to go through this problem together and you follow along with what I'm teaching you, you'll be able to do your homework regarding the Appendix A for Chapter 11 a lot better as well. So let's get to it. We're just going to go through the same format that we've kind of gotten used to. I'm going to give you guys a few seconds to take a look at Exercise 11A-2 on your own, and then I'm going to walk you through the answers. So we got Primera Corporation here. They got a standard cost system in which it applies overhead to products based on the standard direct labor hours allowed for the actual output of the period. Data concerning the most recent year appear below. And there's your data. What they're looking for here is in part 1 they want you to compute the fixed portion of the predetermined overhead rate, and then in part 2 they want you to compute the fixed overhead budget variance and volume variance. So with that being said, I invite you to take 3 seconds to pause your video, and then I will educate you with the answers. Step 1. Look at the problem. Step 2. Figure out the problem. Step 3. Let Tom educate you about the problem. Alright class, welcome back. Hope you had a little bit of fun trying to figure out exercise 11A-2 on your own, and now I'm here to guide you and to make sure that you have all the correct answers. So in the first part of the problem they ask you to figure out the fixed portion of the predetermined overhead rate. Do you know the formula for the fixed portion of the predetermined overhead rate? To figure this out, think about what the predetermined overhead rate formula is. It's estimated total cost over estimated total activity. So think about what the fixed portion of the predetermined overhead rate is. It's the estimated total fixed cost divided by the estimated total activity. And if we take that formula into account, using the numbers that they give us in the problem, we know that the estimated total budgeted fixed overhead cost of the year is $250,000, and the budgeted standard direct labor hours, aka the denominator hours, is 25,000 hours. So if you take the 250,000 divided by the 25,000, you get $10 per direct labor hour. And that is the fixed portion of the predetermined overhead rate. So notice we only needed 2 numbers from all the numbers that they gave us in the chart. Some of those other numbers might come into play later as we go through the rest of the problem, but I think a key point of figuring out how to calculate all these different things is figuring out how to parse through all the information, pull out just the stuff that you need, and plug those numbers into the cost formulas that you know how to do. Alright, so now that we got the $10 per direct labor hour, the fixed portion of the predetermined overhead rate, let's take a step on over to part 2, where they want us to compute the fixed overhead budget variance and volume variance. Alright, so how do we compute the budget variance? Let's focus on that one first. So we know to compute the budget variance, it's going to be the actual amount of fixed overhead minus the budget amount of fixed overhead. So the actual amount of fixed overhead they give us, it's $254,000. That's convenient. We can plug that right in. Now, for the budgeted fixed overhead, they actually gave that to us already as well. That was the $250,000 that we used in the first problem. So, $254,000 minus $250,000 is going to give us $4,000. Now, is that favorable or unfavorable? Since the actual was greater than the budgeted amount, that's going to be an unfavorable variance. And I think that's a key takeaway. You have to make sure that you understand, okay, if my actual is greater than my budget amount, then I'm going to have an unfavorable variance. And it'll be the reverse if the budgeted is greater than the actual amount. Alright, so that part's not too bad, right? Let's move over to volume variance. There's going to be a few more calculations involved in that one. So to calculate the volume variance, it's going to be the budgeted fixed overhead minus the fixed overhead applied. So we already know the budget fixed overhead, right? That's once again the $250,000. So that's simple. We can plug that right in. Now, how about the fixed overhead applied? How do we calculate that? Well, we remember from our readings, to calculate the fixed overhead applied, it's going to be the fixed portion of the predetermined overhead rate, which we calculate in the first part is $10 per direct labor hour, and then we're going to multiply that by the standard number of direct labor hours, which in this case from the chart is apparently 26,000 direct labor hours. So 26,000 direct labor hours times $10 per direct labor hours is going to give us $260,000 of fixed overhead applied. So compare that budget amount of $250,000 to the $260,000 of fixed overhead applied, and you're going to have a $10,000 difference. Now, once again, is that $10,000 difference going to be favorable or unfavorable? Since the budget overhead was $250,000 and the fixed overhead applied was $260,000, the budget amount is less than the overhead applied, so it's going to be a $10,000 favorable variance. So there you have it. You have a $4,000 unfavorable budget variance and a $10,000 favorable volume variance. And that's how you compute a fixed overhead variance. So hopefully this little jaunt that we just went through should reinforce the knowledge that you already know about the appendix to Chapter 11. So with that knowledge, I invite you to go out and tackle all the homework problems that you have assigned for Monday. Good luck with that, best wishes, and I'll see you on Monday.